Thank you, Sagar. Good evening, everyone. From the senior management, we have with us Mr. Anand Roy, Managing Director and Chief Executive Officer, Mr. Nilesh Kambli, Chief Financial Officer, Mr. Anish Srivastava, Chief Investment Officer, Mr. Amitabh Jain, Chief Operating Officer, and Mr. Aditya Biyani, Chief Strategy and Investor Relations Officer. Before we begin the conference call, I would like to mention that some of the statements made during the course of today's call may be forward-looking in nature, including those related to the future financial and operating performances, benefits and synergies of the company's strategies, future opportunities and growth of the market of the company's services. Further, I would like to mention that some of the statements made in today's conference call may involve risk and uncertainties. Thank you, and over to you, Mr. Roy.
Thank you so much, and very good evening to all of you. Thank you very much for joining us today for the earnings conference call of Star Health and Allied Insurance Company for Q4 and for the entire 12 months of the financial year 24. It gives me great pleasure to interact with all of you as we close another successful financial year, in which we gained 3 spots over the last financial year to become the 7th largest non-life insurance company in the country. The Indian economy has continued its growth trajectory, suggesting a healthy economic growth for FY25. Despite strong economic growth, we still have significant part of our population uninsured and underinsured, which poses a financial risk to households and potentially limits their access to quality healthcare. This offers a huge opportunity for the sector to work towards the stated mission of insurance for all by 2047 by the regulator. In line with the IRDAI's vision and to be future ready, Star Health has successfully completed all milestones of National Health Claims Exchange and Ayushman Bharat Digital Mission platform integrations. Star has custom built the entire NFCX and ABDM stack with its in-house engineering team. In the last 2 financial years, we had embarked on a conscious journey of putting risk first and growth later. Some of the key initiatives that we undertook are focus on growth with profitability through robust underwriting guidelines. We realigned the distribution and product mix to cater to the emerging verticals along with our core agency vertical. We built multiple operational efficiencies and focused on productivity improvement and cost optimization measures. We recalibrated the portfolio across verticals and locations and portability and pricing, etc. Our hospital management network management measures were diligent, and our efforts in rationalizing the empanelment of network hospitals and focused on increasing the agreed pricing arrangements in network hospitals. On technology, we made multiple investments. We are one of the leading companies in terms of tech investments in the GI space. Our investments in technology, digital and analytics have improved our customer experience, and prevention of fraud, waste and abuse by deploying new age technologies has resulted in better management in these areas. The above initiatives have helped us in chalking out a path towards secular growth for the years to come. This is reflected in our retail health market share of 33% for FY24. We continue our leadership as the largest player with a size that is 3x the size of the next largest player in the retail health segment. On the service and distribution front, our agency network with 701,000 agents, 881 branches, 20,000 plus healthcare footprint, including 14,200 network hospitals, stands testimony to our mission to providing the best services to our customers. One more important measure where Star Health stands distinguished is on the cost leadership, with an expense of management which is well below the 35% norm as mandated by the IRDAI. I'm happy to share that as a customer-centric organization, we have settled more than 1 crore claim since our inception in 2006, a first for any health insurer, amounting to a disbursal of 44,000 crores over the last 18 years. Our in-house claims management system and adoption of new age technologies has enabled us to process 95% of our claims in less than 2 hours and a 24/7 availability for a seamless experience. With strengthened fundamentals, we are now poised to focus on higher growth with profit. Let me now elaborate further on the financial performance of the company. Coming to the premium and distribution, for the 12-month ended March 24, our gross written premium grew at a rate of 18% to 15,254 crores, compared to 12,952 crores during the same period last year. We are the largest standalone health insurance company in India, and our share of GWP is close to 46% of the entire SAHI insurance space. Our market share for the 12-month ended 24 amongst all general insurance companies is up by 22 basis points to 5.26% versus 5.04% in the previous year. Our agency business contributed around 82% of our overall business for the 12-month ended March 24. Our agency strength has increased to 701,000 agents, with a net addition of 16,000 agents in the March quarter and 75,000 agents in the last 12 months. As accessibility is the key to providing exceptional customer service, we have synergized our presence in bancassurance and digital channels with our existing physical presence, which empowers us to cater to the needs of India, including rural India, that is Bharat. In order to increase penetration in the semi-urban and rural geographies, we have 1,154 sales manager stations, which are small individual service centers. With 881 branches, we have 2,000 plus customer touch points to ensure better service. Of the 19,000 plus PIN codes in India, Star Health is present in 17,106 PIN codes via our sales distribution network. As regards our corporate agency tie-ups, we have now 58 tie-ups in the banks and NBFC space. This channel has contributed to around 5% of our GWP and is growing at a healthy pace of more than 39% as far as fresh premium is concerned. We expect this growth to accelerate as we move forward. Our digital business contributes to around 6% of our overall GWP. The digital channel, which comprises of our own channels as well as third-party aggregators, have been growing at a brisk clip of 34% in fresh business. At a more granular level, 75% of our digital GWP comes from our own B2C channels, and the balance 25% comes from our online brokers and web aggregators. For FY24, we have grown by 108% in the fresh employer-employee group segment, with improvement in pricing and prudent risk selection. This segment also offers opportunities for substantial growth in the coming years. We have received approval to start our GIFT City operations, which will help us serve the needs of NRI customers as well as underwrite business for foreign countries. This will further boost our growth prospects in the future years. I will now talk about some of our claims initiatives and the outcomes. In terms of claims amount, 87% of the paid claims in 12-month FY24 were cashless versus 80% in the previous year. Auto-adjudication of claims through technology has helped us in drastically reducing our turnaround times. 34% of agreed network hospitals, that equate to 75% of the overall cashless claims, have been onboarded on our auto-adjudication platforms. Our anti-fraud, waste and abuse AIML models, which are proprietary to Star Health, continue to yield savings for us in terms of claims outgo. In terms of savings, we were able to attribute 1.5% of the gross earned premium as a direct result of these measures. I will now talk about financial performance. Combined ratio for 12 months ended March 24 was 96.7%, and the combined ratio for the fourth quarter of FY24 was 92.7%. Claim ratio for 12 months ended March 24 was 66.5% and 64.1% in Q4 of FY24. Expense ratio for 12 months stood at 30.2%, and for the fourth quarter of FY24 it was 28.6%. Investment income. Our investment assets have grown to 15,491 crore in Q4 of FY24, showing a growth of 16% year-on-year. The yield for 12-month FY24 was 7.7% versus 6.9% in the previous year. The investment income during FY24 grew 34% to 1,084 crore versus 835 crore in the previous year. The investment income during Q4 also grew by 34% to 293 crore versus 218 crores in the previous year. Coming to our profits, our PBT of 190 crore for Q4 of FY24 was 39% higher than the same period last year. The Q4 PAT came in at 142 crores with a growth rate of 40% over the same period last year. The 12-month FY24 recorded PBT of 1,129 crores showcased a growth of 37% over the same period of last year. And PAT for 12-month FY24 was 845 crores. This is the highest in our company's history and represents a growth of 37% over the previous year. The ROE for 12 months ended March 24 has increased to 14.4% versus 12.4% of the previous year. On an IFRS basis, our PAT for FY24 stands at 1080 crores with a ROE of 17.7%. Solvency, we have a very strong capital base, and our solvency as of 31st March 24 is 2.21 times compared to the regulatory requirements of 1.5 times. Couple of key highlights of Q4 and FY24. With this, I will end my speech. We registered a growth of 41% in agency fresh business in Q4 FY24 over Q3 versus 21% of the same corresponding period of last year. The average sum insured of new policies has increased by 10% on a year-on-year basis to 9.87 lakhs. 5 lakhs and above sum insured now constitute 77% of our portfolio, retail portfolio, versus 70% of the previous year. Our digitally native policy, Smart Health Pro, is showing good promise, and the quarter-on-quarter growth is approximately 33% in this product. The share of our long-term policies within the retail GWP has increased to 6% in FY24 versus 4% in FY23. Furthering our customer-centric approach, an external agency has measured our overall NPS for the company at 56 points. We are about to complete one full cycle in our SHO price hike, and the renewal numbers are holding as per our envisaged plans. Home health care program is now live in 50 cities. Star Health customers can now avail home health care services by speaking with our doctors and medical professionals who will visit their homes to provide them care services. Prevention and wellness, our engagement with customers on our prevention and wellness programs has seen a significant jump. Preventive health checks, PHCs, has increased by 250% in FY24. Our customers are using telemedicine like never before. There has been a 45% increase in telemedicine services this year. Our condition management program has found wide acceptance across the country. Customer app. As regards our Star Health customer app, we have launched a new version of this app in August of 23. Our customer app downloads have increased by 174% in FY24 to more than 5 million plus downloads, and our monthly active users is now more than 7 lakhs, or almost touching 8 lakhs per month, average users per month. Our app rating 4.4 on the Google Play Store and 4.6 on the iOS Store. The average age of our customers over the number of lives covered is 31 years in FY24 as compared to 32 years in the previous year. Organic traffic to the website grew by 46% in FY24 over the same period last year. Star Health is a certified ISO 22301 company for business continuity and management systems, BCMS, and ISO 27001 for information security management systems, ISMS, which clearly depicts a robust governance framework at an enterprise level. To demonstrate our ESG focus, we are able to score 43 points in the first year of active participation in the 2023 S&P Global Corporate Sustainability Assessment. I would really like to thank all my Star Health family members and for their immense dedication and strong support from our shareholders and board members. And last, yet most important, the massive trust placed on us by our valued customers and partners that has enabled to achieve this success. Thank you very much for joining this call today.
So should we open the floor for question and answer session?
Yes, please.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone phone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Our first question is from the line of Madhukar Ladha from Nuvama Wealth. Please go ahead.
Hi. Congratulations on a good set of numbers. I had a couple of questions. First, on the claims ratio, so we've seen some improvement in Q4 after Q3, but it's still higher than Q4 FY23 levels. So, what is our sense in terms of how this number should be over, the next couple of years, given what happened in FY24? Yeah, that's my first question. Next, just a data keeping question, can you split the GWP between travel and PA for the full year? I think you used to give that, but it's not given this time around. Yeah, that's the other one. I'll come back in the queue later. Yeah.
So, Madhukar, on the claims ratio, let us all be clear, we are in the business of paying claims. And we try to make sure that our claims processes are the best in the industry. As we speak, our claims ratio for the fourth quarter has definitely, as 64.1%, and the full year is 66.5%. We are very confident with all the measures that we are taking in terms of our technology interventions, in terms of our network management. We will be able to bring down this claims ratio substantially going forward. But we are not going to compromise on customer services when we are doing that, and that is the direction given to the team. As far as the GWP is concerned, our travel and business is still very nascent. We are growing the book. We have less than, I think, 10 crores in travel insurance, and our PA business is around 225 odd crores. We expect to double down on personal accident business and grow it faster.
Understood. All the best.
Thank you. The next question is from the line of Swarnabh Mukherjee from B&K Securities. Please go ahead.
Good evening, sir, and thank you for the opportunity. So I have three questions. First, sir, I just wanted to understand from the net earned premium front. So net earned premium has lagged the GDPI growth in this financial year. Now that we are moving into FY25, just wanted to understand that assuming that say the GDPI growth remains stable at where it is around 17%, in that case, how should we think about the net earned premium growth? Would it be higher than the GDPI growth this year around as the benefits of the price hike comes in? Or, it will be something in the similar range? If you could highlight that. That is the first question. Second is also wanted to understand, what internal targets do you have for this year in terms of how you want to grow and where you want to take the combined ratio for FY25? And, in terms of growth, so that, FY24 had a large component coming from value growth. So how are we planning to accelerate our growth on the volume side next year, if you can give some color? And lastly, a data keeping question. There has been a reserve release on the IBNR side. So if you could highlight what it was that for, and is this a one-time thing, or should we expect something like that to recur in future?
Swarnabh, good evening. So on the earned premium growth, if you see for the full year, the earned premium has grown by 15%. And it's an average of growth of last year. Last year we had grew our business by 13%. This year it is 18%. So next year, it will be an average of the growth of the 2 years. So we are expecting a growth in line with the growth in business for next year. In terms of value growth and volume growth, this year we had taken a substantial price increase in our flagship product, which has led to higher value growth. But with the expansion that we have done in our agency footprint, with focus on digital business, banker, expect volume growth to pick up in this year.
Sir, would it be possible to maybe give a split between how much for the full year the value and the volume components were in the growth, and how we can think about it in the next year?
Traditionally, the value and volume growth in a year where we are not taking a price increase, it is typically 50-50%. So this year it was more towards value growth, but typically it will be 50-50% in terms of value and volume.
Okay, very helpful, sir. On the growth and combined ratio aspirations, if you could give some color.
The aspiration is to grow higher than the market growth rate. We expect market to grow in mid-teens when it comes to retail health business.
In the group health segment, we are focusing a lot on the SME and MSME segment. We have 2% market share, and that segment offers a huge opportunity for growth. In terms of combined ratio, as Anand sir mentioned, currently we are at 96.5%. Both on the expense ratio as well as the claims ratio, we have taken numerous initiatives which will ensure that we'll improve on this combined ratio.
Okay, sir. So just to rephrase the question, so this year there were, I think higher than anticipated claims that had come in the second quarter, I think partly in the third quarter. If we were to, strip that out and, try to understand what could be a normalized number of combined ratios, where should that number be?
It's very difficult to comment on that, but I mean, the historical loss ratios for us, and this year was an exception.
Okay, got it. And lastly, on the IBNR release, if you could.
Yeah, so what we're publishing is the claim outstanding and IBNR number, which has shown a reduction compared to December. It's a function of the claims ratio. December we have seen a higher claims ratio of 68%. In March, it's 64%. As the inflow of claims reduces, there is a decrease in the outstanding claims because, we pay the claims in less than 1 month. And in terms of cashless claims, these are settled on a 30 days basis with the hospitals. So it's a function of the claims ratio, the outstanding claims and IBNR.
Okay, so if I understood correctly, it is basically the provisions have now resulted in actual claims where the flow has happened.
That's correct. The outstanding claims have got paid over the period of time.
Okay, understood. Thank you so much, sir, and all the best for FY25.
Thank you, sir.
Thank you. Ladies and gentlemen, in order to ensure that the management is able to address questions from all the participants in the conference, please restrict your questions to 2 per participant. If you have a follow-up question, you can rejoin the queue. Our next question is from the line of Shreya Shivani from CLSA. Please go ahead.
Yeah, thank you. So I have 2 questions. First is on the reinsurance side. So last quarter, the reinsurance as a percentage of probably the gross premiums was at about 13%, I think. This time it's lower. The percentage has slipped. So I'm not sure because you guys had said that you've changed your plan and now a bigger portion, because of the higher long-term policies, you've increased the amount of book that you're reinsuring. So where will that percentage settle down? Whether it will be at 5, 10, 13, if some clarity on that would be useful. So second is on the reserve ratio. So for you guided earlier that usually a reserve ratio will be at about in the range of 57, maybe 58% of the net premium. But for this year also, it's come in a little higher at 59, more than 59%. So is that a steady state we should expect, or this was just one of your where would the reserve ratio as percentage of net premiums move towards?
So Shreya, last December, it was a 9-month financials. We had done a retrospective treaty effective 1st April. So that's the reason for the quarter the ceding was higher, but on a 9-month basis, the ceding ratio was 92%, which is maintained for the full year as well, because Q4 we have ceded a similar percentage. Based on the current mix of business of long-term and benefit products where we have reinsurance arrangement, it should be in the range of around 8%, 8% to 8.5% when it comes to reinsurance ceding.
Okay, so on overall book for annual year, 8 to 8.5% is something that we should continue to assume, right?
Correct.
Okay.
On the reserve ratio, I understand what you're referring to is the URR outstanding compared to the NWP.
Correct. URR divided by net written premium. Yeah.
Net written premium. So it was 59% last year. It continues to be 59% in the current year as well. So while we have a higher growth in the long-term policies, because we have done a treaty for the long-term business, the ratio has been constant at 59%.
So this 59, we should assume that this is the run rate, right? Because earlier, I think at the time of IPO or something, I remember we had built in 57 and we were working with 57. So I just wanted to understand why the 57 has moved to 59 and whether this will persist.
Yeah. So basically, there are two things. One is our proportion of group business was around 12%, and group business is done typically in the first half of the year. That's the reason the reserve to NWP ratio was lower. With a higher proportion of retail business and long-term policies, it has slightly shifted in the favor of 59% compared to 57% 2 years back.
Okay.
It's a function of the products and the business that we are writing.
Okay. Thank you. This is useful.
Thank you. The next question is from the line of Prayesh Jain from Motilal Oswal. Please go ahead.
Yeah, hi. Just a follow-up question on one of the previous participants. So if you look at your long-term policy, that how much would have accounted for it in FY24, and also in conjunction with the price hike that we have taken and the impact of which would have been seen in the fourth quarter, largely on the renewal policies, I would ideally assume that the unwinding would happen from URR to NEP at a much higher pace in the next year. So wouldn't the ratio be better? So NEP to say GWP or NEP to NWP would be on the higher side. That would be one. Second, on the loss ratio again, in the 3Q in 3Q call, we had highlighted that there is a significant improvement that we had seen, and the loss ratios were much lower. But eventually the quarter loss ratios have come in at 64%, probably higher than what we would have been thinking. Any adverse movement that happened towards the later part of the quarter that kind of impacted the loss ratio? And lastly, any thoughts on growth in premiums and combined ratios for FY25? How should we think about them? And those would be my questions.
So, Prayesh, on the loss ratio front, you mentioned there was an improvement. So from 68% in quarter 3, it has moved to 64%, which is a 4% reduction when it comes to loss ratio. In terms of NWP to the NEP and the correlation to the price increase, so whatever price increase we do, it gets reflected in the GWP and NWP as well, which flows into the earned premium. So it's a function of the growth in business, which will reflect in the earned premium. In terms of growth, I think we mentioned that we want to grow higher than the market growth rate. We expect market to grow in mid-teens, and we'll continue to improve our market share. There are huge opportunities in the group health business as well, and we'll continue to improve on the combined ratio as well. This year it was 96.5%. With our expense initiatives as well as loss ratio initiatives, we'll have an improvement in both these segments.
No, Nilesh, just on that, on the URR bit. So I definitely agree to the point that the GWP or GDP are definitely, and even for that matter, NWP sees the benefit of the price hike, but but a large part of it would go into URR, right, in the month of March, and that would kind of unwind into NEP next year. So that was the question of even on price hike, as well as the share of long-term policy that you would have written through the period, and would added to that, would it also benefit the combined ratio in any sense for next year?
Yeah, absolutely. Any price increase is done to have an improvement in the earned premium, which results in a lower loss ratio, because the claim trend follows the actual experience in the market, whereas price increase gets reflected in the earned premium. So it will definitely have a benefit in the coming year.
Okay, thank you.
Thank you. The next question is from the line of Nitesh from Investec. Please go ahead.
Thank you for the opportunity, sir. So firstly, if you can share the data on new premium growth for the quarter and for the year. And secondly, what is the price hike you have taken, if any, in this financial year, or you are planning to take in FY25? These are the two questions.
The first question. Right.
Can you repeat the first question, please?
Yeah, so first question is the new premium growth for FY24 and Q4 FY24.
Okay. So see, our new premium growth is very, very strong in Q4 of FY24. We don't disclose that data. We can talk on a one-to-one basis. But right now, we are seeing very strong new business growth, both on the retail side in mid-teens and also on the corporate group business side, we are seeing substantial growth. So there are multiple channels which are firing for us. One is the agency channel, then we have our digital channel, and of course our bank insurance and channel. We have also strongly activated our broker channels, the retail booking piece, which we call as alternate channels, which is also shaping up well, and we expect that these four verticals, which is driving growth for us, will give us good performance for the years to come. As far as the repricing of any products are concerned, yes, we do have some plans to reprice a couple of our products. We had thought about our senior citizen red carpet policy and another product called Young Star insurance policy. Both of these products combined contribute to close to 10% of our GWP. We expect to take a price hike in both of these products in the first quarter itself.
So, what would the quantum of price hike for these products?
Typically, as we have seen in the past, our price hikes varies between 15 to 25%. So we expect something in that range. We are working it out right now.
Sure. Thank you, sir. That's it from my side.
Thank you. Our next question is from the line of Nischint Chawathe from Kotak Institutional Equities. Please go ahead.
First of all, the price hike that we took, effective this year, how much of this benefit has flown in this year, and how much will probably, some of it will roll over next year? So if you could kind of give some color on that.
On a portfolio basis, we would have April as the last month, which will have a direct impact on the price hike. But as far as the net earned premium is concerned, that will flow throughout this financial year also because of all the policies that got renewed over the last 12 months. So there will be some positive impact on the NEP. But on the GWP basis, April will be the last month because we launched the price hike in May of last year. If that answers your question.
Got it. If you could give some color in terms of proportion of business that kind of got ported in, and some color in terms of proportion of business that got ported out to peers.
We are very selective about inward portability, and unlike many other peers in this business, our focus is more on expanding the market and creating fresh business opportunities rather than porting insurance from other companies. Having said that, it's not that we do not accept portability, we do. But less than 7% of our book is new business book is coming from portability, and more than 90% is actually new to insurance business, which we believe is a better underwriting strategy in the long run and to make it a sustainable growth.
And any sense in terms of how much would be ported out? I mean, if let's say, this was not ported out, how much could your growth be, or some color in that? I'm sure there is a way you track that.
So ported out as such, we do have internal trackers, but we do not have any official information. But let me just give you some picture of this. Star Health has the best persistency rates in the industry. Last year also it was no different. More than we were able to secure more than 98% in terms of value of our renewal book. As far as our volume-wise retention is concerned, we had predicted that because of the significant price hike we had taken on the family health Optima product, that there would be a drop-off. We saw that drop-off happening between 4 to 5% as we had predicted. So now how many things were ported out and how many of them did not renew itself, that data, though we have some internal understanding, unfortunately we will not be able to disclose here because we don't know if the data is right.
No issue. Just one small technical question finally. I'm looking at slide 17 on IFRS disclosure. And what I see is that the deferred expenses on procurement cost. Now this amount has gone up, I think, almost 32% year on year. So when your overall business is growing at 18% and this is growing at 32%, how should we really think of it? And I think your overall expenses with commissions this year has gone up by 14%.
Yeah. Nischint, here it's a function of FY22 expenses which were booked in FY23 and FY23 going further to FY24. So it's like an earned premium, something coming from last year and something going from this year as well. So it's a technical thing, and this also shows our investment in business. While 18% is the overall growth in digital business, banker business, we have grown much faster, and that requires a investment in terms of acquisition cost.
So deferred expenses on procurement cost, essentially what? Essentially is that, the expenses that under IFRS, what you have spent this year and what technically has life which you can kind of defer over a period of time. So I believe this pertains to the business that you have done this year, right? It has no, opening balance and roll forward.
That's correct, Nischint, but whatever was deferred last year comes to this year, and whatever business we have done in the current year will get deferred to next year. So, the growth in business that we have seen in Q4, the digital business that we have done, it requires a huge upfront investment. So those get deferred for the future period.
So these are net numbers is what you're saying?
Exactly.
Okay, got it. Thank you. Thanks a lot.
Thank you. The next question is from the line of Supratim Datta from Ambit Capital. Please go ahead.
Hi, thanks for the opportunity. So just wanted to understand, the group business is, has increased as a proportion of your overall GWP. If you could give us some color, how the loss ratio in the group business is currently and how different is it from FY22, when you did this business pretty frequently. So if you could give us some color on that, and what are your aspirations of, building this group business as a proportion of overall GWP going forward? That's the first question. Coming to my second question, currently we have seen, over the last few months, a number of changes on the product design, be it lower waiting period for PDs or, lower moratorium. I wanted to understand what kind of new product development opportunities does this give, and how does this change the profitability or of the product? That would be my second question. And lastly, when it comes to the investment, this year has been very strong when it comes to investment income. Just wanted to understand what proportion of your book is now equities, and what is the tenure of your bond book. That would be very helpful. Thank you.
Thank you. I will take the group business question, and I will request Anish to handle the investment question. Group business actually is divided into two portions. We do underwrite employer-employee groups, mostly focused on the MSME and SME segment, and that's where the aspirations to grow the businesses. And we have seen very, very healthy loss ratios and very profitable book. Most of this business comes from our agency channel currently, but as we speak, we are really opening up the bancassurance and broking channel as far as this particular vertical is concerned, and also our digital channels. So, as you rightly put it, we have a very significant experience of handling large corporates and group businesses in the past. So we definitely are very calibrated in our strategy not to go down any loss-making business opportunities. We will focus on the profit-making opportunities in the SME and SME and probably the mid-corporate segment. That is going to be the sweet spot we will operate in. I request Anish to take the investment questions.
So Supratim, our investment book, which is there in equities as of 31st March, was approximately 4.5%, and over and above that we had around 2.2% investment in REITs and InvITs and some exposures in AIF. So that's how the book is around 6.5%. And in terms of, as I understand you're asking about the duration of the portfolio, So our core fixed income portfolio duration is 3.7, and if we include the liquidity, so duration would be around 3.3 years.
And just one follow-up here. What would be the unrealized gain sitting on the book on the equity?
Unrealized gain as on 31st March is approximately 99 crores.
Okay. And on the regulatory bit, if you could get some clarity there.
Yeah, so there are multiple regulatory, developments happening as we speak. Many of them are in draft stages and in consultation. As far as products are concerned, the regulator is keen to reduce the moratorium period in terms of from 8 years to 5 years. There is some discussion about reducing the pre-existing disease waiting periods, reduction from 4 years to 3 years, and so on and so forth. So I think all of these changes we are obviously watching them closely, and we are designing our strategies. The regulator also does allow insurance companies to take price revisions more freely nowadays. So if that is needed to recalibrate these coverages, we will definitely evaluate that at point of time.
Okay. Understood. Thank you.
Thank you. Ladies and gentlemen, just a small reminder once again, in order to ensure that the management is able to address questions from all the participants in the conference, please restrict your questions to 2 per participant. Our next question is from the line of Anirudh Shetty from Solidarity Investment Managers. Please go ahead.
Hi, and thank you for the opportunity. So my first question was essentially, we aspire to grow faster than the industry like we done in the past. But given the current context is that we are a very dominant leader with 32% market share, and over time there is a possibility that composite license comes through, the industry could get more competitive with life insurers getting in. So how does one think about just the levers of ability to keep growing faster, from this base and with industry dynamics change?
So, we are growing in line with our expectations. We do want to improve our market share, but as I've already articulated, we are growing with a very conscious approach of putting underwriting quality first and growth later. As you can imagine, it's not a very difficult business to showcase growth for the sake of growth. It is not very difficult for us to do that. But how do you grow with quality and on a sustainable basis is the question in front of us, and we believe that we have got the right formula to keep doing that. So we do have, as I mentioned earlier, 4 major channels which we doubled down on. One is the agency channel, which is the main contributor. Then we have the digital channel and of course the bank assurance channel. This year we are also looking at the group channel, the GMC channel, in a larger way. As far as the composite license is concerned, I think this has been going on for a long time now, and we have articulated our views in the past. We believe that this may happen, may not happen. We can't comment on that. But if it does happen, Star Health will be prepared to grab opportunities that comes along with this change in regulations. I think the kind of distribution that Star Health has, the kind of brand recall that we have, and the affinity with our distributors and customers across the country, we are quite well positioned to look at other lines of businesses also, because we believe that if this opportunity does arise, we will grab it with both hands.
Got it. And my second question is, in our group business of say about FY24, it's about 1,100 crores. How much would be SME vis-a-vis the large corporates?
Very insignificant. Large corporate space, as I mentioned earlier,
One final question is, we've done a lot in terms of, using fraud analytics to reduce our claim ratios. Do you see further scope for, improvement here through, just using this analytics, going forward, or we've kind of, maxed out on our ability to kind of take it out, guys?
Yeah, so this is, as you rightly said, this is a continuous activity and endeavor, right? So as we get deeper into, various layers of our business and understand where the opportunities could be to further, either improve our claim assessment quality or our efficiencies in managing those claims or our network management abilities. So I think we keep discovering new aspects, and I think this will be a journey, and this is not the end.
Got it. Good. Thank you for taking my questions.
Thank you. The next question is from the line of Dipanjan Ghosh from Citi. Please go ahead.
Hi, good evening, sir. So just one or two questions. First, on this non-agency-led retail health business that you're originating incrementally, just trying to get some sense of how you kind of envisage the combined ratio in this business a few years out. I would assume that the current origination cost in this business will be tad higher, but probably you would be expecting a favorable claims trend incrementally, which should probably offset that. So just wanted to get some color on how you see the combined evolving in the non-agency segment for the retail health that is getting originated incrementally. Second, data keeping question, if you can give the data on the share of business or number of policies with vintage of more than 4 years currently versus, let's say, what would it have been, let's say, in 2021 or 22, 2-3 years back. And lastly, you alluded to the fact that you'll be focusing on underwriting quality versus growth. And we have also seen, you kind of ramping up on some of the channels out there. So just wanted to get some sense while you kind of give a guidance, but is it fair to assume that as the vintage of the book increases, and given that the quantum of price hikes will be taking in, let's say, 18 months will be lower than what you took in the last 18 months, is it the fair assumption that the overall gross premium growth numbers can see bent on the growth aspect from what we have seen currently in the last, let's say, 2-3 quarters? Those are my 3 questions.
So non-agency-led growth largely comes from our digital channels, D2C, and the web aggregator partnerships that we have. It also comes from our bank assurance and alternate channels to retail brokers. As far as the combined operating ratios of these channels are concerned, they're very, very healthy. In fact, we are investing a lot of our time and energy in growing our D2C piece because it has the best ROEs amongst all our business channels. So we believe that these are definitely worth investing for a long period of time, and we will continue to do so. As far as the share of business of policies greater than 4 years is concerned, we don't disclose that data, but we do disclose what is our persistency. I'm sure you can figure it out. But having said that, we track different cohorts very closely. We make sure that every cohort is profitable on a combined ratio basis, and we take necessary interventions whenever it is needed in terms of price hikes, in terms of calibrating our commissions and incentives and so on and so forth. So we are an 18-year-old company. We have all kinds of cohorts already built into our business, so we don't really worry about renewal cohorts. What we worry about is how do we make sure that customers have a good experience with us, and how do we make sure that we keep servicing them better. And the regulations today allow us enough flexibility to price our products as we need to, and I think that is something that we will keep doing as we go forward.
And so on the growth part, how should one think of it, given that next year, the year after, the quantum of price hikes will be lower than, let's say, the last 18 months?
Our growth has always been led by value growth 50% and volume growth 50%, so we are back to that. we expect that, with the strategies that we have put in place in terms of our agency business as well as our bancassurance and digital business, we expect that growth will be higher than the industry. And definitely we hope that, with our strategies, if we execute well, we will keep improving our market share as we go every year forward.
Sir, just one follow-up on the first question. You said that the return ratios on these new channels are more profitable than your legacy channels. So when you kind of make this statement, it's adjusted for vintage. On a similar like-to-like vintage cohort basis, you're kind of making this statement, right?
Absolutely.
Got it. Thank you and all the best.
Thank you. Our next question is from the line of Shobhit Sharma from HDFC Securities Limited. Please go ahead.
Hi, sir. Good evening. So I have two questions. One is on the number of policies growth. So for the 9 months period, the number of policies growth reported was close to 2%. Wherein we have seen agency channel has shown a growth of only 4%, and the digital channel seems to have a flattish growth. So what kind of growth are we looking towards these kind of channels?
As I mentioned in my opening speech, our digital channels have grown at close to 40% plus in terms of fresh premium. So that number what you're quoting is wrong.
Okay, sir. No worries. This is the public disclosure. Second question, sir, is on the loss ratio. We have reported a better loss ratio, down 4% quarter on quarter. So can you give us the sense that why this loss ratio is down? Is this because of the claim cost inflation which has reduced, or is there a fall in incidence rates?
So, there is an overall increase, yes, but the loss ratio, also consists of our expenses on things like the preventive health checkups, our wellness initiatives, the OPD business and claims. Also, the share of group health business has grown, which works on a higher loss ratio, while, on the combined still works for us because the expense ratios there are lower. So all of those have contributed to the, increase in loss ratio. And some of these are like the numbers you would have seen in the, initial address on preventive health checkups and teleconsultation. There are very, very significant increases that have happened, and this is all an investment in the future so that our future book can be much better. And those are the kind of things we are doing. So nothing really as a major cause of worry.
Okay, sir. Thank you. That's it from us. All the best.
Thank you. Ladies and gentlemen, we would take that as our last question for today. I would now like to hand the conference over to Mr. Nilesh Kambli for closing comments.
Thank you everyone for joining the call. It was a year of transition for us with a new CEO starting FY24, the significant price increase that we took in the FOCO segment, the introduction of EOM regulations and the various initiatives of the regulator as well. With 37% growth in PAT, in FY24, we are fully geared up to deliver stronger growth and a strong financial performance for FY25. Thank you very much.
Thank you. On behalf of Star Health and Allied Insurance Company Limited, that concludes this conference. Thank you for joining us. You may now disconnect your lines.